Hey traders, how's it going? Nick from Vant Trading here, coming at you with a quick little video on stagflation. Now, we do have a video on the Fed that dips into a little bit of this, but we got a question on Friday's Vant and Rant from Ron Staples about getting more information on stagnation, stagflation, inflation, those kind of things. And so there are plenty of resources out there, but I thought I'd put together one of these fun little Prezi videos for you just to give you a little bit of history on this. We're going to talk about what is stagflation, the history of stagflation in the world, in the US, why it matters, the current root causes, the assets you could focus on if stagflation were to occur. At the end, I'll give us a little overview. Do we have stagflation now? Why are we talking about this? Why am I making this video and so on? Because there's a lot going on. There are people in the market getting a little worried, getting a little panicked, especially in the bond market. So without further ado and without wasting any more time, let's dive on in. I'm going to try to make this, brief, entertaining, but also informative. So what is stagflation? Well, if you take two little words here, stagnation, as in from economic stagnation or slowdown, and inflation or rising prices, you take the two parts of the words, you mash it together, and you get stagflation. We're not that creative when it comes to words, apparently. But what is it? Well, there's a couple different ways you could categorize it. A slowdown in economic growth, aka that stagnation. This includes a rise in unemployment that is coupled with a sharp rise in prices. Now, why does that matter? Well, because typically when you have economic slowdown, people are more unemployed, they're less likely to spend, so prices come down. So typically they're inverse, but we're talking about having the same thing here. Inflation plus a decline in GDP. That is usually also accompanied with a rise in unemployment. Or you could say an increase in the money supply, which is outpacing the accompanying economic growth. So you could even have it without necessarily a slowdown or a recession in GDP, but more just the economic growth is just not keeping up with the growing money supply. So you get this coupled thing of economic slowdown with rising prices, and rapidly rising prices at that. And these two things are generally seen as inverse. When inflation's going up, companies tighten the belt. You see them maybe lay off more workers, not hire as much, so unemployment rises. Those people don't spend as much, so then prices go back down, and it kind of balances itself out. But in this case, stagflation, we get both at once. Now, theoretically, it should be impossible. We don't see that here. So hopefully, it's kind of our general thing here. And let's talk about the history, and you might understand a little bit more, because there is a brief and very singular moment of stagflation history that we usually focus on. But first, if we got to go overseas, if you're in the US here, over to jolly old UK. And what this started with is in the 1960s, British politician Ian MacLeod, in a nice, rousing speech to the House of Commons, is generally coined with using the term first. And in his speech, he said, "We now have the worst of both worlds. Not just inflation on one side or stagnation on the other, but both of them together. We have a sort of stagflation situation." And history in modern terms is indeed being made. And yes, history was being made because we have never really seen these two things go together. All economic theory said that this should be impossible, theoretically, but theory and practice are obviously two different things. Now, not to be outdone by the Brits as usual, a couple years later, the good old USA said, "We can do it, but we can do it bigger and better. We'll do stagflation like you never seen before." So in the 1970s, we had our boy Tricky Dick in there, and Nixon came in 1971. They had some slight inflation. It was nothing substantial, but it was growing. And so he did what ended up being referred to as the Nixon shock. And he did three main things that really screwed things up: a 90-day freeze on wages and prices, a 10% tariff on imports, and the removal of the gold standard to the dollar. And a lot of people criticize this as being one of the reasons that inflation really took off, and we saw a lot of issues. So that was one of the first things that we saw. And then second, we had a massive, massive catalyst. There was a war overseas, and we took the wrong side according to OPEC. And I hate to say it, but OPEC really controls oil. So there was a massive, massive embargo on the US from OPEC oil in 1973. This caused oil prices to quadruple over the course of this embargo. Companies cut back on production while also passing on those increased costs to the customers. Feels a little similar to now-ish with the Ukraine-Russia war going on, but that was a massive, massive commodity shock. And then last but not least, you had the then Fed chairman Arthur Burns had actually a very easy monetary policy out there. And not being strict and not trying to curb this inflation fast enough ended up making the commodity prices worse. They skyrocketed even faster, and the Fed was, surprise, surprise, if any of you followed the Fed lately, behind the ball. Now, we know now, and we can infer very largely now looking back and talking with people, that there was a lot of political pressure at the time. They didn't want to raise, these interest rates. They didn't want to cut back on some of this stuff. It wasn't politically popular. And so, we're getting a little glimpse of that now. So this is the history of all of this. And so as a result, we saw inflation launch. You had oil prices quadruple. Inflation went up double digits. Unemployment ended up skyrocketing as a result of just this growth slowdown. And so we had unemployment go double digits. We entered a recession. Prices kept on rising. It was not a good scenario. It was pretty much the worst thing that the U.S. had seen well, maybe not the worst. We had the Great Depression, but it was a very, very tricky scenario that the U.S. was not prepared for. And so that was kind of how the U.S. was like, we can do that, but we can do it better. So what was the result of all this? Because the result was largely what was worse. And I'm going to take myself off the screen here. So in 1979, Paul Volcker became the Fed chair. And for those who know history, might recognize this name. He came in with inflation that had peaked in 1980 at 14.8% year over year. We saw massive, massive inflation. And so at the time in 1979, the federal funds rate is 11.2%. 2 years later, he had jacked it up to 20%. For those who have watched our other Fed video, understand, he really rose the Fed funds rate. And what that ended up doing was pushing us straight headlong into a recession. We had a nice, about 2-year-long recession. We hit it hard, and it caused a serious economic slowdown. However, by 1983, inflation was under 3%. So, we kind of had almost a reset, if you will. And that's how he ended up kind of steering us through that and into something else. Now, he didn't come back. That's when Alan Greenspan then came in, and we moved on from there. Now, Richard de Keyser, who, and I'm sorry if I'm pronouncing that wrong, but he has actually had a couple quotes about this. He is the executive vice president and chief corporate economist at Wells Fargo, and he was essentially saying that the worst part was actually the aftermath, because to reverse the course we were on, a severe recession was required, and it then took a decade, not until the 90s really, that the fears of the inflation resurgence started to subside. So this was not just like a one-time thing. Oh, we've got stagflation. How do we fix it? I guess we got to have some pain for a year. No, this shook the U.S. economy for a little bit, caused some fears in investors, and people didn't quite know how we were going to emerge out of it and how quickly inflation could just suddenly come roaring back. So now you understand at least a little bit of the history of why, you don't really have a way to lower inflation, especially if you have supply chain bottlenecks like an oil embargo, without completely ruining U.S. economic growth. And that's what we ended up having to do to fight this inflation. So that's the history of stagflation that we've really seen. We haven't really seen it since, not in any kind of serious manner. So why does this matter? Why are we suddenly hearing, the media pundits, saying, oh, stagflation's coming, it's going to derail the economy? Because this is typically what is referred to as the Federal Reserve's worst nightmare. This is kind of why people are so worried about stagflation. So the Fed has a dual mandate, for those who don't know, and I'm not going to dive into this exactly in the nuances of the Federal Reserve. We have videos on this on our YouTube. They're free. Check them out. We go more in depth into some of this stuff. But generally, they need to promote maximum employment, have stable prices, and a moderate long-term interest rates. So they're fighting inflation and unemployment, which we've talked about as being kind of inverse. So it's a balancing act. Now, like I said, there's a bigger video. So with that dual mandate, stagflation thus becomes the worst case scenario. Because first of all, theoretically, it should be impossible. Now, like I said, it's an example of economic theory and reality being a little disjointed, not to throw economic theory out the window. But the Fed has tools to fight inflation. It also has tools to fight economic stagnation. But it does not have a tool that can fight one without making the second one worse. Hence why Volcker only got a handle on it all once the U.S. dipped into recession as a result of him jacking up rates. And that ended up putting a curb on inflation. It put a curb on growth as well. And by the time the reset was over, things had kind of, quote unquote, gone back to normal. So that's kind of what we saw as a result of there. And that's why it's largely considered a Fed's worst nightmare, because since it's theoretically impossible, we theoretically don't have any tools at our disposal to just fix this and make it go away. So We're going to see what the Fed does if we do experience that. So I think we can boil this down to the most agreed upon two root causes of stagflation: supply shocks. A la in the 70s, we had supply shocks of many things, especially oil, or fiscal and monetary policy. And fiscal and monetary policy can absolutely drive us right into this without, without us even really needing to go in here. So currently, what are we looking at? What's the current situation, and why are we talking about this? Well, because we're kind of seeing this to an extent in labor. Fewer people are working. The job workforce participation rate has dropped. We have a serious inverted job openings versus unemployed workers out there. And there's a very hot and competitive jobs market. In terms of goods, look, we just had COVID. We are dealing with serious shortages, semiconductors in particular, supply chain bottlenecks out the yin yang. There are a lot of issues with getting your goods on time and in a cheap manner. Services, people postponing elective surgeries, healthcare worker shortages out there, all sorts of service issues as a result of people leaving the workforce feeling not appreciated or due to vaccine mandates or whatever. This kind of goes along with labor, but it also just goes along with people not necessarily spending on those things. Policy. Oh, policy. If you've watched us for some time, you know that we have talked about the Fed and their lunacy, in our opinion, and how behind the curve they've just been. They just finally stopped buying assets. They just finally, at the end of last year, said, oh, you know what? Inflation, yeah, that might not be transitory. They've been saying the word transitory all the way up to that point. Now, maybe not. So the Fed is behind the curve on everything, and they just finally have started their first rate hike. They haven't even touched the bloated balance sheet, and we've got issues out the wazoo here. The government. Let's talk about the government. We have tariffs out there. We have embargoes on foreign oil. We have foreign policy that's obviously pressured by a lot of geopolitical events going on. But we have issues in terms of getting imports out here and getting our exports out there. We have an administration that is very strict on oil amid rising oil prices. So I'm not saying that the government could have avoided this. I'm not saying that this is solely the responsibility and the result of the government. But let's be honest, a lot of this is a result of the global economy literally shutting down when COVID first came, and completely shutting down and having to restart. That is a big reason for a lot of this. But there are a lot of policy errors out there that are making things worse. And one of the root causes of all this is not only supply shocks, which we are experiencing with shortages, with supply chain bottlenecks, with people leaving the workforce, but also with policy error. And we're seeing that on both sides, both in fiscal and monetary policy. And that's not just our opinion. It's a pretty wide opinion out there. We'll see if it all works out in the end. So if we go into stagflation, before we talk about if we're even going to have it, if we do eventually have stagflation, what are some assets that some people might want to look at? Well, these are ones that typically would outperform during stagflation. The one time that we had stagflation, these outperformed, and these are theoretically what we would expect to outperform if it were to happen again. Commodities and commodity players. Obviously, things like gold, very high in terms of, kind of fear index. People go to gold for safety. So miners, gold, agriculture in many ways, a lot of those commodities and commodity involved stocks and companies will probably outperform the market. REITs, that's anything dealing with real estate essentially. Due to a pass-through of price increases in rental contracts and property prices, REITs do tend to outperform the market. We're not saying they're going to do stupendous in all cases, but they will likely outperform the market. Treasury bonds, some people say, you can flood the treasuries, there's a safety, but they're a mixed bag, because if we are going to have that record high inflation, that is going to eat into your income. It is going to put upward prices on yields, the downward pressure on prices, and you may not get as much as you hope. Who knows? It all depends on what the inflation ends up being in the subsequent result. There are TIPS, which are Treasury inflation protected securities. So it's a little bit of a mixed bag there. Now, the interest rates will be lower due to inflation protection. And there are some cases, I'm not going to dive into TIPS here, but there are some cases for higher taxes. But if inflation is going to show up, and if it does, that may be one of the best courses. Crypto, who knows? Crypto is still kind of new and uncertain. It's very volatile right now. And, while gold is outperforming right now, crypto's kind of in the gutter. And we're not seeing that pick up. So it's still very speculative, not really a safe haven. That could change, but crypto may be something in the future. Stronger foreign bonds. Maybe don't go internal. Go foreign. Look for countries that are going to handle these kind of issues better, and look who's going to outperform, according to you or an analyst or whoever, in the future. So these are some of the assets that we would be first looking at if we think stagflation is on the horizon. So Now that I've kind of talked about that, do I think stagflation's on the horizon? Is stagflation here? Should we panic? Do we have stagflation now? What is the current situation? Currently, people are earning less. Wages are increasing, but at the wrong rate, at a rate less than CPI. So real wages are dropping month after month after month. So you've got less money out there. Personal savings rate as a percentage of disposable personal income are at levels lower than pre-COVID. So we are having some economic issues in terms of the power out there. We are paying for more than things. People are talking about inflation. Obviously, CPI is at 7.9%. That is the highest CPI we've had in decades. We have uncertainty from the war in Ukraine. We have China locking down still because they have a COVID zero policy, and that's going to make supply chains worse. You have oil spiking as a result, a lack of production increases from OPEC. So you have rising oil prices. This feels a little reminiscent of those 1970s. So you have kind of those echoes, especially in people that may remember some of that. They're starting to feel a little deja vu. But do we think that there's stagflation coming? So I have a little chart here, and I'm going to answer it no. Not yet, at least. Now, obviously, things can change. If the administration gets their act together, this could all easily turn around. Well, maybe not easily, but this could all turn around. But let's compare things here. This left-hand column is what things were like in the 1970s. The right is now. Oil quadrupled, $2.9 a barrel to 11.65 by the time the embargo lifted. We had oil quadruple. We're only up about 25 to 30% so far. So far, that could change. It was about $75 a barrel at the start of 2022. And now it has been rising going into that as well. So, take that into account. But a quadruple from that would be the equivalent of $300 a barrel. We just barely touched 130 before we reversed. So we have a while to go before we see that kind of shock in price rising. Inflation, we had double digits. It was reaching up to 14.5% inflation. For years, we had massive, massive inflation. Now we're seeing at 7.9%. It's still the hottest in decades. I am not saying that this is bad, not bad inflation, that this is bad. This is very bad. This is the hottest inflation we've had pretty much since the 70s. So we're starting to see that. It's already growing. Unemployment, double digits in the 1970s. I don't know exactly what the average was, but we were seeing serious unemployment. We're still only sitting at 3.6% unemployment right now. Now, the labor market, in my opinion, is still shaky. The job openings, the labor turnover, it is a very, very competitive market. The labor participation rate seems abysmally low, in my opinion, and I don't know what's going to fix that. I think there are really some issues in the labor market underneath, but we don't have that double-digit unemployment technically because people aren't looking for work necessarily. 30-year mortgages got up to 11.2% in the 1970s, and that made housing very unaffordable for the middle class. Right now, we're just barely above 5%. So, we are rising. We're getting there. And along with rising housing prices will increase the odds or decrease the odds of you being able to afford a home, but we're still not quite there. And then interest rates. We got up to 20% from Volcker. 20%. We're at 0.25 to about 0.5%. Yeah, we're getting there. And look, we can't get to those previous levels due to high government debt and the issues that would cause, but there's a lot more runway ahead of us. And we can see the cliff. We can see it coming. The question is, can the Federal Reserve, can Jerome Powell steer us out of this without having us crash into a recession? That's what he's trying to do now. He's trying to avoid the Volcker method. He's trying to raise rates, though many people think he's not being aggressive enough. Some people think they should be focusing on the balance sheet first. There's a lot of differing opinions right now because we are at a very different situation now than then. Our balance sheet is much higher. Our government debt much higher. It is a different playing field. But what are we going to be able to do? What is happening? So in conclusion, look, this is like I said, this is a very different world from the 1970s. Obviously, we've got a lot of new technology. We've done QE since then. Like I said, our balance sheet has exploded. The Federal Reserve has been buying and buying and buying. We can't raise rates necessarily to that same level because the federal government has obscene amounts of debt. And so, what are we going to do here? And what is the maneuverability that the Fed has? Are we locked in this position towards stagflation? Because the Federal Reserve can't fix supply chain bottlenecks. It can't touch oil. That's OPEC's game. And so, even though the Russia war is causing an impact on oil, Russia only really supplies about 10 to 12% of global oil. They supply a big percentage of energy and gas to Europe, but globally, it is actually a relatively small amount. small. So, what are we going to see there? The Fed can't touch it. Obviously, they can't really influence government in terms of the fiscal policy. And yes, they're supposed to be independent politically, but they're not. Let's be honest. There was political pressure there as well. We're heading into midterms. So are we locked in towards this stagflation path? What is going to happen? This is what the Fed's trying to figure out. So we're definitely heading in that direction. Obviously, inflation's still rising. You've got supply chain bottlenecks still sitting there. Oil still going up. So the path is still set before us. The question is we do have some time before us to see what the Fed's going to be doing. But you see the worry in the bond market. You see the threats of a recession coming. Will the recession come soon, and then will that cause inflation to fix? Or are those supply chain bottlenecks so stuck, and is the oil price so stuck that even if a recession comes, are they going to stay? And then at that point, we're there. We're in stagflation. We have the two root causes of stagflation, policy and supply shocks. So it's going to be the worst case scenario for the Fed if it does happen. Who knows what will happen? You've got a lot of people pricing in the expectation of a recession in the next year or two. So the question is going to be, can we get the supply chain shocks fixed? And can we get inflation down before we hit that path? Because people are already pricing in the expectation of the Fed lowering rates in the next year or two. So there's not going to be much wiggle room for the Fed. And it's going to be very interesting to see what happens. I'm not saying that we're going to hit stagflation, but now you see why people are talking about it. Why is this a talking point in the media, and why are people so concerned? I hope that this was helpful and informative. I didn't want to go too into the weeds here. This video was already 20 minutes as is. If you stuck with me through it, I hope it was entertaining. I hope it was at least enjoyable, and maybe you learned something. I don't know. I kind of kept it basic to an extent as well. There is so much more information you can go out. Just go to Google. Just go to our YouTube. You'll find plenty of information, but I hope that this at least sets you on the path to understanding, where we're headed and why people are worried, why you're seeing the bond market do what it's doing, and why you're seeing a lot of uncertainty from investors. This was Nick from Vant Trading. I appreciate you all for tuning in. Drop us a like or drop a comment if you have any questions or you think I may be misconstrued something, but we'll see you next time. And as always, safe trading.